Are there special iron condor margin rules? If you are curious about the margin rules for the iron condor strategy in options trading, you are in the right spot. Let's break down what you need to know about these specific margin requirements. The iron condor is a popular strategy that involves for options contracts on the same underlying asset with the same expiration date. It consists of selling an out-of-the-money put spread and an out-of-the-money call spread at the same time. Because this strategy has a defined risk profile, the margin requirements reflected the maximum potential loss rather than an unlimited risk scenario. So, how is this margin calculated? The margin requirement is generally based on the width of the spreads involved. You take the difference between the strike prices of the short and long options on either the put side or the call side, whichever is greater. Then, you multiply that difference by the number of contracts and the contract multiplier, which is usually 100. For example, if you sell a short put with a strike price of 170 and buy a long put with a strike price of 160, the difference is 10 points. If you are trading 10 contracts, your margin requirement would be 10 times 10 times 100, totaling $10,000. This amount represents the maximum potential loss if the spread moves fully into money. It is important to note that the margin is reduced by any premium received when you open the position. This means the net margin requirement is the strike difference minus the credit received. This calculation ensures that you hold enough collateral to cover the worst-case loss scenario. To qualify for the special margin treatment under exchange rules, all options must be on the same underlying instrument, have the same expiration date, and have different strike prices. Additionally, the strike widths of the put and call spreads must be equal. If the strike distances differ, the position will be treated as two separate spreads, each with its own margin requirement. Brokerage firms often use margin optimization software to minimize margin requirements by recognizing the iron condor as a single position rather than separate spreads. However, in some cases, the system might not identify the iron condor structure correctly, which could lead to higher margin requirements. In practice, margin requirements for iron condors are typically lower than for uncovered options because the risk is defined and limited. This makes iron condors appealing for traders who want to generate income while managing risk effectively. Keep in mind that margin requirements can vary from broker to broker and by account type. If the underlying price moves against your position and your account equity falls below maintenance levels, you may face margin calls. In summary, the special margin rules for iron condors reflected their defined risk profile. The margin is calculated based on the maximum potential loss of the spread, adjusted for any premium received, and requires all legs to meet specific criteria. This allows traders to manage risk and capital efficiently when using this popular options strategy.